Everyone has a different perspective on the world. Some see a modern world with towering buildings that embody the spirit of the times, an abundance of all kinds of goods and endless choices. But others see a cruel world, a place of hostile instincts and deception, predatory desires, and greed that send people into a relentless frenzy. Those with schemes and ulterior motives are constantly jostling for position. On the surface, it seems there are more choices, but in reality, more and more people are just being swept along by the current without even realizing it. Then there are those who see a world in bewildering change. Perhaps it's due to scientific and technological advancements, or maybe a shift in thinking, or a difference in value systems. But it could also be just a vague feeling that even they themselves are changing subtly without noticing. In these respects, the world is indeed changing, but it also seems not much has changed at all. It's just that the form of change has concealed the repetition of its essence. Just like in the past, those who don't create products get to decide the fate of those products. Those who don't perform the labor reap most of the rewards. But the difference today is that the producers are becoming more and more hidden, even becoming invisible, while the intermediary class, the merchant capitalists, become increasingly prominent and vocal. So the issue isn't really just about how the world is changing, but how we should perceive the root of that change. And this is the subject of Volume 3, the third volume of Capital. Perhaps many have realized that nowadays, being good at producing is less important than being good at selling. Here, producing refers to industrial capital, which we discussed in Volume 2. It includes money capital, productive capital, and commodity capital. These three forms constantly circulate and interact, creating the cycle of production and circulation. On the other hand, being good at selling pertains to merchant capital, a distinct part separate from industrial capital. It consists of commodity dealing capital, often referred to as intermediary merchants or traders, and money dealing capital, such as banks. Some might wonder why Marx makes such a clear distinction in Volume 3. Isn't it all just capital? In fact, this distinction is crucial and demonstrates Marx's foresight, because over time, a portion of capital began to withdraw from the sphere of production and shift into the phases of circulation, gradually giving rise to the current reality of who controls the flow in circulation is the one who reaps the profit. As for who the producer is, where the factory is located, or whether labor is exploited, these become issues that are no longer important to the majority of consumers. This differentiation, from hundreds of years ago until now, is still ongoing on a global scale. It's very important for us to understand how capital develops and is formed, as well as how it has affected and continues to affect our lives. As Marx wrote in the original text, because modern economists, even the most distinguished ones, often equate merchant capital with industrial capital, and because they completely fail to see the characteristics unique to merchant capital, it is therefore essential that we make a clear distinction. This is absolutely necessary. First, let's examine how commodity dealing capital in merchant capital differs from the commodity capital in industrial capital that we have talked about previously. These two concepts only differ by the word dealing, but in terms of operation and cycle, there is a very large difference. Commodity dealing capital does not directly produce products, nor does it participate in the production process. It acts like an intermediary, buying goods from the producer and then selling them on the market. The goods are then sold to consumers or other producers, thereby generating added value and further driving surplus value. This type of capital exists entirely within the process of circulation. Let's take an example to illustrate. Suppose you go to a large supermarket to buy a shirt. This shirt wasn't sewn stitch by stitch by the supermarket. They bought it from a factory. So in this case, the supermarket is playing the role of commodity dealing capital. They use money to buy shirts in large quantities from the factory, then sell them to you to make a profit. Although the supermarket doesn't directly produce the product, through this activity of buying and selling, that is, the cycle from money M to commodity C and back to more money M, the flow of goods from the factory has reached your hands, and at the same time, the supermarket has made a profit. This is the typical operating model of commodity dealing capital. At this point, some people might ask, if this profit could be claimed by the factory itself, that is, the industrial capital, then why would they cede it to an intermediary merchant. You said before that the nature of capital is the pursuit of profit and value, appreciation, right? So why would they be content to share profits with others and even allow merchant capital to grow so strong? Actually, this is a natural result of the social division of labor. The activities of merchants serve an intermediary role. Without them, the factory would have to both produce and sell the goods itself. That would cost them additional time, effort, and money for the sales process. This could cause a temporary stagnation in the production process because they would need to wait for the capital to turn over, or they would have to front the money to maintain the next production cycle. The risk is also very high, for instance, if the goods don't sell. In that case, the factory is forced to reserve a large amount of extra cash. As a precaution, this money, which could have been used to expand assets, is now held back, just to ensure that, even if the goods don't sell, there is still capital to continue production, not to increase output, and promote growth. However, when merchant capital intervenes, the producer can focus all their efforts on the production stage, thereby speeding up the next production cycle or expanding their scale. The merchant uses their own capital to buy the goods, making a profit, but also shouldering the risk in the circulation process, such as unsold goods or a drop in price. Thus, the factory focuses on production, and the merchant handles the buying and selling. The efficiency of both parties is higher. Therefore, we can understand why factories at the source often have lower prices, but mainly sell in large quantities. From this, we can also see clearly why, as merchant capital develops, it tends to become more concentrated and prominent. Let's take the shirt example again. If the factory sold at retail itself, it might take a whole week, or even longer, to sell everything and recover the capital. Meanwhile, the supermarket, with its existing sales channels, like chain stores or online platforms, might only take a few days to sell everything. Once the factory receives the money from the supermarket, it can immediately buy fabric, start the machinery, and continue making shirts. Conversely, if the shirt goes out of fashion or the price drops sharply, the supermarket has to bear this risk and use its own money to cover the loss. To minimize risk, the supermarket is forced to find ways to optimize and integrate resources. This gradually creates a trend of centralization. Once you understand this, you'll see why we said from the beginning that compared to industrial capital, merchant capital is an independent system. Merchant capital circulation cycle is from M to C, while industrial capital circulates according to the cycle from money M to commodity C, then to production P, then to new commodities C, and finally back to more money M. Commodity dealing capital, on the other hand, has a circulation that is simpler, from money M to commodity C, and then back to more money M. This cycle has absolutely no production stage, meaning there is no production P element and no new value is created. That also means it happens faster and more flexibly because it only operates in the sphere of circulation, not bound by production time. Therefore, its turnover speed is usually faster than industrial capital's. And with the same amount of capital, a merchant can turn it over multiple times, handle many types of goods, or even serve many different production sectors. Take the supermarket example. Suppose they use 100,000 RMB, equivalent to about 350 million Vietnamese dongs, to buy shirts from the factory. After selling that batch of goods, they can use the money they've earned to import tables and chairs, home appliances, or any other product. They are not limited to just clothing. In contrast, the shirt factory has to wait for the entire shirt production process to be completed before it can enter the next capital turnover cycle. This is the characteristic flexibility of merchant capital. If a merchant buys cotton or fabric from a supplier and then sells it to a clothing factory, then in this case, the party they are serving is the industrial capitalist, no longer the end consumer. Therefore, merchant capital doesn't just sell to consumers. It can also supply goods to many industries, even crossing the boundaries between industries. Its circulation cycle is essentially the circulation process of many different types of industrial capital. At this point, we have understood the basic operating mechanism of merchant capital, but not deeply enough. We've only seen the buying and selling phase. We haven't touched on the workers' labor and the surplus value in production. Let's start digging deeper with a common misconception. Many people think that merchants make money by marking up the price of products. For example, buying at a price of 100 RMB and then selling it for 110 RMB, making a profit of 10 RMB. This kind of price increase, at first glance, makes it seem like they are arbitrarily creating profit, or even that it's a fraudulent act. But this is only a surface phenomenon. In reality, the total value of the commodity is created during the production process. When merchants sell at a high price, it's not that they are creating new value themselves. Rather, they are taking a portion of the surplus value that already existed in the production process. In other words, a merchant's profit doesn't come from them selling goods above their true value. It's because they buy the goods from the producer at a price lower than the commodity's actual value. An even more serious mistake is to confuse value with price. This is the key point in Marx's political economy for distinguishing between phenomenon and essence. We analyzed this part in detail in the previous episode, so we won't repeat it here. In summary, the merchant's profit is not generated in production. They do not produce value, but are merely facilitators of the value exchange process. However, in the market, that profit manifests in the form of a price increase and is passed on to the consumer. Therefore, merchant profit appears as a price increase, but it does not increase the actual value of the commodity. This explains why we always emphasize that the merchant's profit is, in fact, a portion of the surplus value ceded to them by industrial capital, and this concession is the key. If we don't clearly distinguish between these two types of capital, we will fall into the trap that Marx criticized, which is to fall into an ideological way of thinking, mistakenly believing that profit comes from the merchant's talent for trade, and thereby forgetting that the source of all value is still labor, the labor power of real flesh and blood workers. This very misunderstanding obscures the fact that surplus value is the result of the exploitation of labor, making the exploitative relationship in capitalism seem rational, as if it were fair and based on equal exchange. Someone might ask, if that's the case, what about when merchants arbitrarily push prices too high? What then? For example, nowadays there are gimmicks like selling anxiety, idle culture, or the bandwagon effect. All are used to continuously raise prices. Even though merchants don't create value or surplus value, doesn't this mean the price has exceeded the commodity's real value? Won't the rate of profit also exceed the initial surplus value? So how is this explained? The answer lies in the distribution mechanism of the total social value and the equalization of the rate of profit to an average. Let's break this problem down step by step. First, as mentioned in Volume 1, the value of a commodity is determined by the socially necessary labor time, which includes production costs and the surplus value. Tricks like selling anxiety or media effects do not increase the intrinsic value of the commodity. They are just ways of manipulating the market through advertising and marketing to influence consumer psychology, making them willing to pay a higher price without realizing it's an artificial price, disguised under the cloak of a legitimate consumer culture. However, the profit from such price hikes is still a redistribution of the total surplus value in society. The merchant doesn't create new value, but simply relies on marketing, brand promotion, or personal reputation to capture a larger share of the value in the market while pushing other competitors out of the game. For example, a product endorsed by a celebrity and sold at a high price, thereby capturing market share, is in fact redistributing the surplus value created by the entire production system, from the workers to the research team, into their own hands. Therefore, that high profit is not generated by the merchant capital itself, but is a transfer of value created by labor in the sphere of production. Marketing techniques and branding do not create new value. They only change the way existing value is distributed. If this concept still seems abstract, imagine it like this. A dietary supplement uses fear to advertise that it has miraculous effects in curing diseases. They sell it for 10 million Vietnamese dongs, while the actual cost is only about 100,000 Vietnamese dongs. The difference of 9,900,000 VND is not newly created value. It is money transferred from the consumer's pocket, or indirectly taken from the market share of other producers. To put it mildly, this is a redistribution of surplus value within society. To put it bluntly, it is market fraud, appropriating value, and destroying the competitive environment. Price-cutting strategies also operate on a similar Logic. Businesses are willing to accept short-term losses to capture the market, eliminate competitors, and thus monopolize and reap greater profits in the long run. There is only one special case that both changes the intrinsic value and raises the price. That is fraudulent behavior. For example, selling duck meat but advertising it as lamb, a classic bait and switch. This behavior is outside the scope of our theory and is clearly illegal. After understanding these points, we can recognize a key point. Merchant capital and industrial capital both operate around the average rate of profit. If the profit from commerce is higher than from production, industrial capitalists will abandon production to become merchants. Conversely, if commercial profit is lower, merchants will turn to production. Therefore, in a dynamic competitive market, the profits of both sides will gradually converge toward the average. However, the difference lies in the fact that merchant capital does not directly create surplus value, but it demands a share of that value. Therefore, the participation of merchants in the circulation chain, the participation of merchants in sharing the surplus value, will reduce the average rate of profit for the entire society. In other words, the more merchants there are, the lower the rate of profit for the producing class. That is, the industrial capitalists will be, because the surplus value must be shared among more parties. Imagine the entire surplus value is a cake with 100 slices. Initially, the industrial capitalist could have taken the whole cake. But because the merchant is willing to take risks, helping to sell the product and speed up the production process, the producer agrees to give 30 slices to the merchant, keeping 70 slices. The merchant doesn't bake the cake. They just take a slice from it. If people see that baking the cake, meaning production, can yield a bigger share, then capital will pour into production. Conversely, if commerce offers a bigger share, then the flow of capital will shift to commerce. This flexible process is part of the movement of history. In fact, merchant capital is the earliest form of capital to appear in history. Since ancient times, merchants have played a central role long before capitalism took shape. Commercial profit often determined production profit because merchants controlled the market. In the capitalist era, commerce was redefined as a portion of surplus value. In the Middle Ages, merchants would buy grain cheaply from farmers and sell it at a high price in the cities, making huge profits. But as industrial capital developed, factory owners began organizing production and sales themselves, and the role of the merchant diminished. At this point, profit no longer came from selling at a high price, but from sharing in the surplus value. Today, e-commerce platforms and live stream selling are new manifestations of merchant capital at a high degree of concentration. They replace small traders with warehousing systems and automated logistics, which are more cost-effective, more efficient, and don't even require a physical store. That also answers the initial question of why, today, being good at selling is more important than being good at producing. It is a trend formed by the continuous development of commerce. From this, too, we can understand why many people are frustrated, but cannot explain why. Merchants don't farm, don't produce, yet they make huge profits from buying and selling. Or why celebrities who sell via live stream earn even more money than the producers themselves, and even have the power to set prices higher than the brand. Clearly, the products are made through the hard work of farmers and laborers. Yet, in the end, they receive only a meager share. Many people think it's because of influence or web traffic. But in reality, it's the dominance of merchant capital in the sphere of circulation. It's just that we are used to seeing the circulation process as a neutral act, a transfer from A to B. In reality, circulation today has become a tool for the self-expansion of capital. The difference between the past and the present is that today there are legal and regulatory systems that limit its disorganized growth, keeping it within a controllable range instead of letting it expand freely as before. Even so, some people will still feel uncomfortable and wonder, will this model stay this way forever? Will the future be different? Marx provided a specific analysis in Capital, especially regarding the circulation process and the cost structure of merchant capital. Besides the cost of purchasing goods, what other types of costs do merchants bear? In their operations, we can divide them into two main groups: purely commercial costs, like office rent, employee salaries, operating equipment, and so on, and production-related circulation costs, which include transportation, warehousing, and packaging, factors that may be related to extending the production cycle. And these costs, depending on their nature, can be further classified into constant capital, and this capital can be divided into constant capital and variable capital. However, it should be noted that purely commercial costs do not increase the value of the commodity. They are merely necessary expenses to realize that value. For example, a supermarket can buy goods, but without premises and employees, it cannot sell them. Meanwhile, production-related circulation costs, such as transportation, can increase the use value of a commodity. For example, by moving it from point A to point B. But this doesn't necessarily increase its exchange value. We can illustrate this as follows. Suppose a supermarket spends 100,000 RMB, approximately 350 million Vietnamese dongs, to buy apples. At the same time, it must rent a warehouse and pay employee salaries. These costs do not increase the value of the apples, but they are necessary conditions to be able to sell them. They are the necessary costs to operate the merchant capital. The supermarket selling price, therefore, must not only recover the 100,000 RMB for the apples, but also cover the 5,000 RMB for warehouse rent, approximately 500,000 Vietnamese dongs, and 10,000 RMB for salaries, approximately 35 million Vietnamese dongs, as well as the desired profit. Clearly, these costs are covered by the selling price, but they do not increase the actual value of the commodity. They are only added to the price under the name of commercial profit. At this point, a question arises: are the salaries of commercial employees considered a productive investment? If so, then salaries plus profit would increase the selling price. If not, why do merchants still have to pay salaries? The answer is that the labor of commercial employees, although it doesn't create new value, helps to realize pre-existing value. That is, they take on a part of the circulation, function on behalf of the producer. Therefore, the wages they receive are actually deducted from the surplus value and do not generate any new value. You can picture it like this. Commercial employees are like water carriers. They don't create more water, but they ensure the bucket of water is moved from the place of production into the hands of the consumer. Merchants are willing to pay them because they help circulate value, and ultimately, both the wages and the profit come from the surplus value created by the production workers. Understanding that, we can summarize the operating cycle of merchant capital. From M, money, to C, commodity, to M, more money. In this cycle, money is used as a means of circulation, constantly turning over. Each turnover brings a profit. For example, using 1 million RMB, approximately 3.5 billion Vietnamese dongs, to buy phones, then selling them for 1.1 million RMB in total. When all are sold, bringing in 1.1 million RMB, that's a profit of 100,000 RMB per turnover. If this process is repeated 10 times a year, the profit is 1 million RMB, approximately 3.5 billion VND. The faster the capital turns over, the more goods are sold. But the total profit earned depends on the scale of capital and the average rate of profit, as discussed in previous sections. From this, we can see that industrial capital drives both the production and consumption processes, while merchant capital is entirely dependent on industrial capital, continuously producing goods to release onto the market. Simply put, if no one bakes the cake, then fighting over how to slice it is meaningless. Merchant capital has a parasitic nature. Phenomena that are criticized, such as excessive marketing or selling based on reputation, are in fact all based on the power of merchant capital. Therefore, the relationship between marketing, advertising, and audience traffic must all be tied to merchant capital. And merchant capital, in turn, depends on production capital. And production capital must extract from surplus value. To put it gently, this is a mutual support. But to be more blunt, this relationship is essentially a form of mutual parasitism. But you should note, whether it's support or parasitism, the relationship always has two sides. It should absolutely not be seen in a simple, one-sided or static way. If we want to be more precise, we should call it symbiosis. The two sides rely on each other to exist, but at the same time, they also limit and constrain each other. The turnover speed of merchant capital is limited by the speed of production and the speed of consumption. If goods are produced slowly, meaning industrial capital can't produce fast enough, then merchant capital will also circulate slowly. Conversely, if consumption is weak, like in the early industrial period, when workers were overexploited and had low incomes, causing the whole of society to lack the purchasing power for goods, then merchant capital will also stagnate. They are always in dynamic interaction. On that basis, we need to introduce another core element, price. The relationship between the price markup and the turnover speed is an inverse one. The faster the turnover, the smaller the price markup on each unit of commodity. The slower the turnover, the more each item's price must be raised to cover costs. However, price is always limited. The price floor is the production price, which is determined by the producer, not the merchant. The price ceiling is the price that can be achieved to ensure the average rate of profit, determined by the total social capital and the level of consumer acceptance. This still sounds abstract. So let's take an example. Fast-moving consumer goods like bread, milk, bottled water, and simple t-shirts all have a fast turnover cycle. Each unit is marked up by only a few percent and sells very quickly. Conversely, luxury goods like watches and jewelry have a slow turnover. Each item must be marked up to many times its import price and therefore sells slowly. Even so, the price floor is still the import price from the factory. It can't be sold below cost. The price ceiling is the level at which the commodity can achieve an average profit if a merchant breaks this rule. For example, by raising the price of a bottle of water from 2 RMB, about 7,000 Vietnamese dongs, to 50 RMB, about 175,000 Vietnamese dongs. In theory, it's possible. But in reality, will the market or consumers accept it? When other competitors are selling the exact same product for just 2 RMB, who will buy the 50 RMB bottle of water? In that case, can a fast turnover speed still exist? Isn't it true that not all commodities can be priced arbitrarily? Except for special cases like monopolies, or possessing technology that cannot be replicated, it is very difficult to set the selling price unilaterally. If you are the only one in the market, or even in the whole world, with that product, only then do you have absolute pricing power. But in reality, that is nearly impossible. Of course, some might argue, what if I change the packaging, create a compelling story, get a celebrity endorsement, pour money into massive marketing and label it miracle water or sacred water? Wouldn't selling a bottle of water for 50 RMB be a piece of cake? It sounds plausible, but remember, changing the packaging, hiring people, and running ads all require upfront investment with real money. It doesn't just come from thin air. When you add in those costs, the cost price of each bottle is no longer 2 RMB, but has increased significantly. Not to mention, you also have to bear a huge risk. For example, what if no one accepts it and spends the money to buy it? Finally, each type of commodity today has its own implementation standards. For example, regular drinking water and mineral water have completely different standards applied to them. Real goods cannot be faked, and fake goods cannot escape scrutiny. And if you deliberately launch some kind of miracle water with healing properties, then that is a criminal act. These are the products that fall into the blacklist category, often mentioned on legal affairs programs. Returning to the main topic, everyone can now clearly understand that the commercial profit is the result of taking the total merchant capital, multiplying it by the average rate of profit, and then dividing by the turnover speed of commodities. Whether the price of each item is high or low does not affect the annual profit, but it does determine the markup rate on each individual unit of product. And the somewhat rambling examples we just discussed are precisely what Marx criticized. Common assertions, like sell cheap, make a large profit, or sell dear, make a small profit, depend entirely on the will of the merchant. But in reality, the merchant's price markup is limited by the production cost and the average rate of profit, what we just referred to as the upper limit and the lower limit. The merchant can only choose to deal in expensive or inexpensive goods, and this choice is constrained by the scale of their capital and market conditions. When the productive capacity of society increases, the cost of producing goods will fall. At this point, a merchant can use the same amount of capital to acquire more goods, but at the same time, the circulation capital also increases. For example, costs for transportation, warehousing, and other infrastructure must also be added. Furthermore, when the turnover speed of goods increases, the capital a merchant needs for each unit of product decreases. This means that for the same volume of goods, less capital is now needed to turn it over. However, the total quantity of commodities in society is rapidly increasing. As a result, the absolute amount of merchant capital may increase, but its proportion relative to industrial capital decreases. This is what Marx pointed out in Principle. The capitalist mode of production has a twofold effect on the merchant. On the one hand, the acceleration of turnover causes the necessary merchant capital to decrease. But on the other hand, with the development of capitalist production, almost all production activities are converted into commodity production, causing the total quantity of commodities to increase sharply. These two trends offset each other. Although the capital needed per unit of commodity decreases, the total output increases, leading to a situation where the total amount of merchant capital can still continue to increase. However, its ratio to industrial capital decreases. For example, in the early 19th century, the unit price of products was high, productivity was low, and there were few types of goods. The turnover speed of merchant capital was slow, and transportation was inconvenient. At that time, the commercial profit margin was usually high, so the proportion of merchant capital in the total capital was also high. But in the period of advanced capitalist development, productivity increased and commodity prices fell sharply. Almost every product could be brought to market. The turnover of merchant capital became faster, the commercial profit margin decreased, and merchant capital occupies a lower proportion of the total capital. However, the overall scale of commerce has expanded to an unprecedented degree. This also partly explains why in the industrial capitalist era, as society continuously develops, the rate of profit in commerce tends to decrease, but the actual total volume of circulation continues to increase. In all of this, we haven't even mentioned the role of banks or speculative capital. Once those factors appear, you will understand why speculation exacerbates the internal contradictions of capitalism. In fact, everyone can easily recognize a phenomenon. Economic crises usually don't erupt from factories or stores first. Instead, they start in the commercial and banking systems. To speed up turnover, merchants borrow money to buy goods from factories in large quantities. Now they don't need to wait for goods to sell out before restocking. They can rely on credit lines to continuously replenish their inventory. However, when factory owners exploit workers excessively and justify it by claiming everything is the result of natural selection to hide the true nature of exploitation, it leads to the majority of workers not wanting to buy or even not having enough money to buy goods. As a consequence, goods in the market sell poorly or even become stagnant and unsellable. When goods start to become surplus, merchants' inventories also become more and more stagnant, but they still have to repay their bank loans on the due date, including both principal and interest. Although the goods can be mortgaged to repay debt, the interest cannot, so they are forced to raise selling prices to recoup their losses, selling whatever they can, recovering whatever little they can. But this is the beginning of a vicious cycle. The more they raise the price, the fewer people buy. When a large amount of merchant capital cannot be repaid on time, a crisis will erupt. People start to panic, banks experience mass withdrawals, goods can't be sold, and money can't be withdrawn. Confidence collapses, the stock market plummets, and then a financial crisis breaks out. Of course, this interpretation is an extremely simplified version. As we've mentioned before, the outbreak of a crisis is usually the result of many combined factors. Furthermore, in modern times, banks and financial institutions all have risk assessment systems. However, their development was not a complete step right from the beginning. And this is another form of merchant capital that we mentioned at the beginning, money-dealing capital. It can also be understood as the forerunner of banks and modern financial institutions. First, money-dealing capital is an independent form, separate from production capital and traditional merchant capital. It specializes in handling money-related activities, such as deposits, withdrawals, payments, and reconciliation, etc. Unlike merchant capital, this type of capital does not directly participate in buying and selling commodities. It operates as an independent department, providing services to production capital and merchant capital. Simply put, it only works with money. At this point, people will surely wonder two things. First, how did money-dealing capital come into being? Second, if it doesn't participate in production, then why does it exist? or commodity trading. How does it make money? We mentioned in our episode on Volume 2 of Capital that the circuit of money capital begins with money, is converted into commodities, and then enters production to create surplus value. But as the scale of capital expands, the circulation of money, making payments and collecting money becomes extremely complex, time-consuming, and labor-intensive. It's also cyclical and requires a large amount of capital. In that context, producers were forced to separate out the financial functions that were not production-related, so they could concentrate on the production phase. And it was at this moment that money-dealing capital began to form. Just like merchant capital, this was the inevitable result of the social division of labor. Initially, it only existed as an auxiliary accounting role, but later it gradually developed into an independent department. You can understand it like this. Some people produce, some people trade, and there is also a group that specializes in handling money. For example, some people help you exchange money from pound sterling to the Dutch guilder. Some help with deposits, withdrawals, and there are also people who specialize in handling complex payment orders. These people don't produce commodities, nor do they buy and sell directly. Their job is to help money operate more smoothly and efficiently. Their profit comes from a share of the surplus value that the production capitalists or merchants are willing to part with in exchange for convenience in circulation, like a commission fee. It can be understood that initially they made money by providing services that helped production and merchant capitalists focus on making products and trading commodities. Later on, as capital developed and business activities globalized, they could also profit from the difference in exchange rates when dealing in foreign currency. However, one point to note is that many people easily misunderstand that this service fee is the same as the fees that modern banks collect. Today, the fees that money dealers collect are not just service fees. They also include interest. But it's important to note that this type of interest is different from the interest on loan capital. At present, we have not yet entered the realm of credit or interest-bearing capital. This part will be analyzed in more detail in the next episode. Many of you are probably curious about how they profit from foreign exchange rate differences. So let's expand on that a bit. First of all, money has two parallel functions. One is as domestic currency used for circulation within a country, and the second is as world money, such as gold or silver, which was widely accepted in global trade at that time. Each country had its own currency, and in international trade, merchants were forced to convert their own country's money into another's or exchange it for gold and silver. Otherwise, no one would accept the transaction. At that time, money dealers acted as intermediaries, helping to exchange money and collecting a service fee. Besides a fixed fee, they also took advantage of the spread between the buying and selling rates, selling foreign currency at a slightly higher price and buying it at a slightly lower price. That spread was their profit. Besides that, there was another form called a commercial bill, for example, a bill of exchange. This is a note that specifies a commitment to pay a specific amount of money at a future date. Merchants who needed cash urgently, but whose payments were not yet due, would sell this bill to a money dealer at a discounted price, meaning lower than the face value written on the bill. When the bill matured, the buyer, that is, the money dealer, would collect the full value written on the bill, thereby profiting from the difference. The essence of this model is a combination of service fees and information and time arbitrage. However, regardless of where the profit comes from, exchanging money, discounting bills, or transaction fees, in the end, they are all portions separated from the surplus value generated by production and trade. Hearing this, you might see that this activity contributed to improving the operational efficiency of the entire economic system. But at the same time, it also created many contradictions and differentiations, including speculation, inequality, and risk. This is its twofold character, and it is also the precursor for the formation of modern financial capitalism. First, it has a parasitic nature. It doesn't directly create value itself, but still takes a share of the surplus value from production capital. If production stagnates, this financial activity will also be affected. To ensure a continuous flow of profit, money dealers will often engage in speculative behaviors, such as manipulating exchange rates, excessively discounting bills, or using credit leverage to make quick profits. These behaviors while they might bring large short-term profits, are extremely dangerous in the long run. Once the market fluctuates, or the surplus value in the production sector declines, large blocks of bills may not be paid, exchange rates may collapse, the credit chain will break, and a crisis will erupt. The contradiction here is that this activity lives off the surplus value of production, yet it undermines the stability of production